Last quarter, Meta earned $15.85 billion. Its free cash flow was $1.75 billion, 9 times less. Both figures are true and both come from the same document. In 3 months, Meta invested $30.12 billion in data centers, chips and the electrical grid that feeds them. Almost twice what it earned and half of everything it took in. Understanding why those two numbers drift so far apart is basically what it means to analyze a company. 7 lessons that work for any business. But first, who this company is, because you need it to follow everything that comes next. 3.5 billion people use its apps every day. Meta Platforms is the company that was called Facebook until 2021. It sits in the communication services sector, in the internet content and services industry. In plain words, its business is selling attention to advertisers. It was founded in 2004 and went public in 2012 on the NASDAQ. Today it is worth $1.37 trillion, and it bills $228 billion a year. And here is what a lot of people do not have in mind. Under Meta sit Facebook, Instagram, WhatsApp, and Messenger. Plus Reality Labs, the virtual and augmented reality division, the one that makes the headsets. And the $30 billion we just named goes to these 5 things. An income statement is read from top to bottom, and it is a staircase. At the top, revenue $60.8 billion. Below it, each cost takes away a step. First come the costs of running the business, $35.67. What is left is called EBITDA, $25.13. It is what the business earns before subtracting the wear on what it already bought. And now that wear. It is called amortization and depreciation, and it is $6.36. Subtracting it leaves EBIT, operating profit, $18.77. From there down the business no longer decides. The bank and the tax office do. Other expenses, $20 million. Taxes, $2.91. And right at the bottom, net profit, $15.85. Look at where the depreciation sits, because that is the trap in this staircase. It has no line of its own in the income statement. It is spread inside the operating costs, so it is already subtracted even though you cannot see it. We pull it out here so we can show it to you. Now let us split those costs, because they do not weigh the same. Cost of revenue, servers, delivery of the service and the electricity bill they run up, $11.33. Selling and administration, $9.04. And research and development, $21.66. The largest line of them all, bigger than the profit itself. 35% of everything that comes in goes into researching and developing new products. And one clarification just in case. Building the line and the substation is investment. It stays on the balance sheet and comes off little by little, through depreciation, for every year it serves. The electricity that runs through them is an expense. It is charged in full to the quarter in which it is consumed. And this is what has changed in a year. Revenue is up 28%. Operating costs are up 65%. They move the same way at different speeds, and that difference has a name. The operating margin, what the company keeps out of every $100 after operating. It went from 43 to 30.9%. The lesson, when revenue rises and the margin falls, the problem is not in sales. It is in the cost. And then you go looking for it. Imagine you buy a warehouse for $10 million. 10 leave your cash today, in one go. But in the income statement you do not subtract 10. You subtract the part that belongs to this year, because the warehouse will serve for 20, $500,000. And you repeat that subtraction for 20 years. Same money. One single hit to the cash, 20 small bites out of the profit. The profit barely moves. The cash has been emptied. That $500,000 we subtracted each year has its own name, depreciation. And it is 3 things, not 1. First, it is paid. That is the outlay, and the money leaves the bank in full on day 1. Then it is spread. The income statement expenses it in pieces, 1 each year, while the asset serves. And at the end it is used up. The charge ends when the asset stops serving, and what is left is a fully depreciated asset. Cash leaves once. Profit is charged every year. And it is worth separating 3 things that share almost the same name. What you can touch, servers, buildings, substations, wears out with use, and spreading its cost is called depreciation. What you cannot touch, a license, a patent, a piece of software, expires with time. And there the right word is amortization. And what was paid over the odds when buying another company goodwill is never broken into pieces. It is left alone and reviewed each year in case it is worth less. 2 are spread in pieces. The third is not spread. It is reviewed each year. And all three cut profit without a dollar leaving the bank. Depreciation, intangibles, and goodwill are the three figures on the screen. Meta has $249.71 billion of physical assets. Servers, buildings, networks, which do depreciate. Intangibles with an expiry date, 0. And goodwill is 23.41, which is never amortized. That is why this quarter's charge is in full, depreciation. And this is that charge quarter by quarter in billions. 3.9, 4.34, 4.96, 5.41, 6.0, 6.36. Not one pause. Which is why, even if Meta stopped building this very afternoon, its margin would not come back on its own. What is already built keeps weighing. Investment is a decision of 1 quarter. Depreciation is a bill that lasts 10 years. Every data center Meta puts up today leaves a cost written into every set of accounts for the next decade. Profit measures what the company earned in the quarter. Cash flow measures the money that actually moved through the bank. The same quarter, measured twice, and the two figures do not match. Profit does not pay the bills. Cash does. The difference has 3 causes, and they are different in nature. The first 2 are real expenses that moved no money. One was paid years ago when the asset was bought, and it is called depreciation. The other was settled in ownership, handing over shares instead of money, and it is called stock-based compensation. The third is different and is called working capital. It has not moved yet. It is not an expense. It is a timing gap. And careful, because it did pass through the profit in both directions. What you are owed already added as revenue without you collecting it, and what you owe already subtracted as a cost without you paying it. What is missing is not the entry, it is the money. That is why the first 2 always add, and the third can subtract. The first 2 are an expense that never left the bank. The third, an entry that has not moved yet. Paying in shares has a bill, and it is worth seeing before we go on. This quarter, Meta handed over $7.66 billion in shares to its employees. That is what was booked as an expense, and not $1 left the bank. But the entry only tells half the story. When those shares vest, Meta keeps part of the stock to pay the employees withholding, and that withholding it does pay in money, $4.28 billion. More than half of what it booked as an expense really did leave the bank, only to the tax office and in the financing section. And of buybacks, 0. It did not buy back a single share to offset the dilution. A year ago, there were 2.516 billion shares. Now there are 2.548 billion. That bill is paid in full by the long-standing shareholder. Now the whole path, correcting the 3 things in order. First, the expenses that came off the profit without leaving the bank. Depreciation. And share-based compensation, those 7.66 we just saw, and the 2 small steps are let. Other non-cash items, 1.5 billion, almost all deferred tax. Booked now, payable later. And working capital, $500 million. At Meta, working capital is moved mostly by 2 lines because it has no inventory. It does not manufacture anything that sits waiting in a warehouse. What the advertisers owe is accounts receivable, and it grew by 4.4 billion. Already billed, already counted as revenue, and still not collected. On that side, the cash does worse than the profit. Pulling the other way are accrued expenses, booked and still unpaid, which grew by almost 6 billion. They pull in opposite directions, and with the smaller lines, working capital ends up leaving that $500 million. At Meta, the gap between collecting and paying barely moves the cash. With that, the 15.85 of profit turns into 31.86 of cash generated by operations, more than double the profit. And it is the cash from operations, not the profit, that really rules the business. One step is left, and it is the one that takes almost everything. Investment in fixed assets, what is spent buying things that last, and which in the accounts is called CapEx, takes 30.12 billion in a single quarter. What survives that subtraction is free cash flow, 1.75 billion. It measures what the business generates on its own, minus what it costs to keep it standing. And now the series, which is where you see what has happened. Operating cash flow is growing, 24.6% more than a year ago. Healthy, rising, no surprises. But look at what investment does, and look at what is left underneath. Free cash flow for the quarter is 1.75 billion. In the same quarter last year, it was 9.02. 80% less, with a business doing better than it was then. Meta's cash flow statement, activity by activity. Operations, 31.86 comes in, and that column comes in whole. Investing, 49.65 goes out, and of that only CapEx counts, which is 30.12. Almost all the rest is 17.04 that the Treasury moved into marketable securities, and that was not spent. And in financing, 15.97 comes in on the plus side. New debt of 24.91, minus 1.35 of dividends, and minus the taxes on the net share settlement. From that column, nothing counts. And a warning about the figure. Free cash flow is not a line in any accounting standard, just like EBITDA, which is not one either. Every company works it out its own way, so always ask for the formula before comparing two of them. The three columns add up to minus 1.83, and that figure is something else entirely. It is not what the business produces. It is how much the cash balance changed over the quarter, after everything, after what was earned, invested, borrowed, and paid out. 1.75 is a production. Minus 1.83 is the difference between two balances. A flow and a balance are not compared. And that balance that changes is not the same one the balance sheet calls cash either. They are two different perimeters of the same money. The first started the quarter at 23.43 and ended at 15.46. It fell by almost 8 billion. The second started at 81.18 and ended at 90.26. It rose by 9 billion. And the third gives minus 1.83. That therefore is the one Meta adopts in its financial statements, even if it is not the one it highlights in its press release. All three are true at once. Between the first and the second, there are 17.04 billion net that Meta took out of the current account and put into financial securities. And that is not money spent. It is money moved. It is still theirs. It has changed pocket. So when someone tells you Meta's cash has fallen, the right question is which one? And none of the three is free cash flow. The 1.75 is not a cash balance. A balance is a stock, and a flow is a movement. A stock says what there is. A flow says what moved. 4 figures, 4 different questions, and not one of them answers the others. 30 billion in 3 months. Data centers, servers, chips, and the lines and substations that supply the electricity. The lesson: a company can make money and run out of money. If you only look at the profit, you do not see it. Free cash flow is the first figure that separates whoever has read the accounts from whoever has read the headline. If the cash does not cover the investment, someone puts up the difference. That is always on the balance sheet. The balance sheet is a photograph, not a film. What the company has on the last day of the quarter and who has a claim over it. What it has is called assets. What it owes, liabilities. And the difference between the two is equity, which in many places you will see called shareholders' funds. It is the same thing, and it is what would be left for the shareholders if everything were wound up today. The two columns measure exactly the same thing. That is why a balance sheet always balances. Meta's total assets, 280 billion 6 quarters ago. Today, 450 billion, and a definition that is needed straight away. Net debt is debt minus the money in cash, what it would still owe if tomorrow it paid everything with what it has. Meta's was 21 billion, and today it is 97 billion. Now look at the ratio everyone checks debt to equity. 0.43. Any analysis screen calls that fine, because below 1 is considered prudent. An analyst in a hurry turns the page. But a ratio is a division, and that ratio uses gross debt, what is owed without netting off the cash. Gross debt has multiplied by 2.3. And equity by 1.4 at the same time because retained earnings fatten it every quarter. Top and bottom grow together and the division barely flinches. Net debt, the one that nets off cash, not the securities, has multiplied by 4.7. Same company, 2 measures, and only one of them shows up on the screens. The lesson, and it works for any company. When you see a calm ratio, look at the numerator and the denominator separately before you trust it. A quiet quotient does not mean nothing is moving. A few hours after publishing the accounts, the company holds a call. Management sits down with the analysts who cover the stock, and that call is public. Anyone can listen to it and the transcript is published. It contains 2 very different things, stuck one after the other. First, a text written weeks in advance, reviewed by the finance team and approved by the lawyers. Then, improvised answers to questions management did not choose. Almost nobody separates them. We do. We count the words of each half separately, and this is what shows up. The call is in English, so the words are exactly as they said them. The size is how many times each one is said, and they group themselves. While they read the script, the vocabulary is that of the business that already works. Advertising, revenue, and improvising, it is that of what they are building. Build, compute. The cloud says which words they use. Now we count them, which is what turns an impression into a figure. Performance comes up 15 times while they read, and 0 times answering. Open source, 0 times reading and 11 answering. Same people, same hour, same company. And on the right, where the conclusion comes from, sentiment in the read part is 0.519, and in the answers, 0.331. Positive words go from 2.82% to 2.11, and sentiment falls 36% between one half and the other. But that needs explaining, because it does not come from counting the words in the chart. It is measured sentence by sentence with a model trained on financial text, which gives each one a probability of sounding positive, negative, or neutral. And what it really teaches is what moves. The negative does not move. It is marginal in both halves. What collapses is the positive, and what rises is the neutral, which in the answers becomes more than half of what they say. So improvising, they are not saying bad things, they stop saying good ones. More concretely still, in the prepared section there are 9 commitments with a figure and a date. In the answers, none. The lesson, when they stopped reading, they stopped committing. That is not in any financial statement, and you do not have to take anything on faith. They are counted words from a public text. A figure on its own says nothing. What says something is the position, where a company sits against others that make money the same way. We chose 5: Alphabet, Snap, Pinterest, Reddit, and AppLovin. All of them sell attention to advertisers, and comparing properly means comparing 5 things. How much it keeps of what it takes in, whether it can pay what it owes this year, how much it owes, how much its share moves, and how much it costs. The first 3 come from the income statement and the balance sheet, and they fill this first table. Profitability. Of every $100 that come in the door, Meta keeps 38.1 after paying all the costs of making the business work. That is the operating margin, and of the 6 only AppLovin keeps more, 77.1. AppLovin has no social network. It places advertising inside other people's apps, and that trade leaves more. The column next door measures how fast that revenue is rising. At Meta, it rises 27.7% over 12 months. At Reddit, it rises 66.6%, the fastest of the 6. At Snap, it rises 10.3%, the slowest. Liquidity. For every dollar Meta has to pay over the next 12 months, it has 2.23. That is the current ratio, and it answers whether it gets to the end of the year without selling anything. 2.23 is comfortable in any textbook, and at the same time it is the lowest of the 6. In this column, Meta comes last. Leverage. Meta owes, after netting off its liquidity, about 2.5 months of EBITDA, the operating profit before subtracting depreciation. It is net debt divided by that EBITDA, and it says how much time of business profit it would take to pay back everything owed. It sounds like nothing, and it is. Alphabet, Pinterest, and Reddit have more liquidity than debt. They owe nothing net, and that is why their sell carries no number, and AppLovin owes even less than Meta. But the case to look at is Snap. It owes money net, and its EBITDA is negative. Its ratio comes out negative, and here a negative number is not good news. It means the business does not generate enough to pay back what it owes. Meta is the one that owes most in dollars. Snap is the one least able to pay it. Those are not the same thing. And the last column measures what that business returns to its owner. The money shareholders have in the company returns 26.1% a year at Meta. That is called ROE, and in that column Meta comes 4th of 6. AppLovin, Alphabet, and Reddit get more out of their shareholders' money. The same 6 companies now by what it costs to sustain the business and by what the market pays for it. 3 cash flow columns and 3 market ones. How much the share moves and how much it costs. Meta turns 18 of every $100 it takes in into free cash flow. AppLovin turns 71.4 out of every 100, almost 4 times more. And Alphabet stays at 11.9, below Meta. And here is the column that explains Meta entirely. Investment. Meta invests 39.1% of everything it takes in. Alphabet invests 29.7%. Reddit invests 0.3%. Comparing Meta with Reddit by what it earns, and not by what it has to invest to earn it, is comparing 2 different trades. That column carries no color on purpose. Investing a lot is not better or worse than investing little. It depends on whether what was invested ends up producing. And the last of the block is what each one pays in shares. Meta pays 11% of its revenue in shares. Pinterest pays 21.1%, the most of the six. AppLovin pays 3.8%, the least. Volatility. Meta's beta is 1.25. When the market moves, it moves 25% more. That column carries no color for the same reason as investment. Moving a lot is neither good nor bad. It is bad for someone who needs the money next year and good for someone who has it parked for 20. Price. At today's quote, Meta costs 21 years of its current profit. Alphabet costs almost 18, Pinterest 50.5. The same industry, the same advertisers, and almost 3 times the difference in what is paid for each dollar of profit. And 4 cells in this table carry no number. None of them is a missing figure. Snap has no PE because it loses money, and there is no number of years of profit when there is no profit. And Meta, Snap, and Pinterest are left without a peg. The PE divided by how much the profit grows, because their profit did not grow. At Meta and at Pinterest it fell, and at Snap there is no profit to speak of. Only Reddit, Alphabet, and AppLovin have one, and Reddit's 0.12 is the lowest of the 3, and that 0.12 does not say cheap. The peg divides by last year's growth, looking backwards, and Reddit's profit multiplied by more than 3 from a tiny base. You divide by an enormous growth rate that does not repeat 2 years running, and the peg sinks on its own. The price has not changed. That is why a very low peg almost never means cheap. It means it grew enormously last year. One detail both tables declare, and that is worth saying out loud. 3 of the 6 have not yet published the June quarter, so their 12 months end in March. The calculation rule is the same for all 6. The cutoff date is not. The lesson. The comparison with the competition that only looks at price compares the price. And looked at whole, this one says something we did not expect when we built it. Meta is not first on any of the 5 axes. Second in margin. Fourth in what it returns to the shareholder. Last in liquidity. More leverage than AppLovin. And second in price. Because Alphabet costs less. That does not make it a bad company. 38 of every $100 in operating margin is not something anyone can sign. What it does is change the question. If the biggest company at the table does not come first at anything, what you have to work out is not whether it is good, but what the market is paying for and why. And an empty cell that says why it is empty teaches more than the number it is missing. There is a comparison that measures management without naming anyone. Every quarter the company announces in advance how much it expects to bill in the next one, and gives a range. Then it publishes the real figure. Putting the 2 side by side across 9 quarters tells you whether management understands its own business. Meta broke its own range 6 times out of 9, always on the upside, never on the downside. The impulse is to applaud. Turn it around. If you always come in above and never below, you are not forecasting well, you are promising little. The lesson. A good management team is not the one that beats expectations. It is the one that can say in advance what is going to happen in its own business. Everything we have seen so far is figures. But a company is not only its figures. There are decisive things no financial statement captures. Whether its customers can leave, whether it hangs on a single regulatory decision, whether its advantage can be copied. To organize that there is a 40-year-old tool, the SWOT, and it has a trick that makes it useful. It separates 2 axes. The first, present or future. Present is what the company already is today. Future is what could happen. The second, for or against, which is whether that plays in its favor or against it. You cross the 2 and 4 boxes come out, and each one has a name. Present and in favor, strengths. Present and against, weaknesses. Future and in favor, opportunities. Future and against, threats. The axes are drawn on the plate, so you can see where each box comes from. Meta's strengths. 3.5 billion people use one of its apps every day, and that is the strength all the others come from. Its operating margin is 38% when the median of its competitors is 28%. And on price it comes second. With a P/E of 21, of the 6 only Alphabet costs less. The 4th is not in any headline, but in a note to the quarterly report. Its $84 billion of debt carries not one financial covenant, and almost none of it matures before 2030. A company with debt without conditions and without any hurry cannot be forced to sell anything in a bad year. Weaknesses which are homegrown and present. The margin has fallen from 43 to 30.9 in a year. Corporate governance ranked 80th out of 81 in its industry, and the one almost nobody looks at. It pays in shares double what it buys back. Over 12 months, it has handed over 25.14 billion in shares to its employees and has bought back 12.02. The difference is put up by the shareholder in the form of a smaller slice of the same company. This quarter, it paid 7.66 and bought back nothing. And a fourth that also comes out of the notes, and that changes how last year's profit reads. Of every $23.50 of earnings per share, one came from lengthening the accounting useful life of the servers. Not from selling more or spending less. From deciding that the machines would last more years and spreading their cost across more periods. The company quantifies it in the annual report. In management's summary, it appears as a slowdown in the rate of depreciation, and now what does not depend on it. Opportunities. That it separates out in its accounts which part of the revenue artificial intelligence really brings in, that it announces the ceiling on the investment, or that it cuts back the scope of reality labs. And a fourth that comes out of the balance sheet, that it publishes how much of its construction in progress enters service and when. That is 80 billion being built that today neither produces nor depreciates. None of the four is a wish. All four are things management can announce on the next call, and that is why they are opportunities and not fantasies. Threats. That it keeps investing faster than it monetizes. That what is already built keeps depreciating for 10 years, whatever happens. That it is paying for an unproven business with the cash flow of the one that does work. And the fourth is the hardest to find because it is not on the balance sheet. It is underneath. The commitments Meta has signed and that do not yet appear as debt add up to 628 billion, 140% of everything the company has. In December, they were 235 billion. They have multiplied by 2.7 in 6 months, and they are in a note that takes up half a page. The lesson, is not a list of adjectives. Every box has to survive one question. Where does this come from? If the answer is not a figure or a verifiable fact, that line does not belong. And notice something. Everything on the left has already happened, and everything on the right has not. Confusing the two columns is the mistake that turns an analysis into an opinion. Judging a whole company with a single score can be done. Not by looking at whatever catches the eye, but by measuring 12 different aspects of the business and giving each one the weight it deserves. And it is the same procedure for any company you analyze, because we have taken 7 looks at the same company, and impressions do not add up. A company can have excellent liquidity and a debt that frightens you. Without a declared weight for each thing, the judgment is carried off by whichever figure makes the most noise, and a score is not there to get the price right. Nobody does that. But to force you to look at the same things, in the same order, in every company, and to be able to compare today's with next month without memory playing tricks. And before a single score, what each axis measures and with what. The first 6, financial health, whether it can pay its debts. It is looked at with net debt against EBITDA and by checking whether short-term assets cover short-term liabilities. Growth, how fast revenue rises, averaged over the last 5 years. Valuation, how much you pay for each dollar of profit. The PPE competitive moat, whether the margin holds up against rivals and whether the share is sustained management. We do not judge people. We measure whether it gets its own forecast right. And sector position, its size and where its share is heading. The 6 look inside the business, whether it holds up, whether it grows, what it costs, whether it defends its place, whether management gets it right, and where it sits among its peers. And the bar on the right is its weight. The longer the more it rules the score, and the other 6. Momentum, how the share behaves against the index and against its own averages. Risk, how much it moves and how far it has fallen from its highs. SWOT balance, whether the strengths weigh more than the threats. Catalysts, how many dated commitments it has met of those it announced. Sentiment, the language of the call, what we have just counted. And corporate governance, how power is shared and what rights a small shareholder has. Each one weighs differently, and the weights are published. The first 4 take almost half the score. Sentiment and governance, 6% each. The rule that makes this worth anything. No figure can enter through 2 axes. If the margin scores in financial health and again in the moat, its real weight is not the one the table says. It is the sum of the 2, and the score stops saying what it declares. Our score has 12 dimensions, each with its weight, and you have them labeled on screen. None is set by eye, and this is the only technical part of the video. A raw figure is not a score. Growth of 18% is not an 8 or a 4 until you decide what you are comparing it with. So for each metric 2 references are fixed. In revenue growth, ours are: growing 0 is worth 0 points, growing 20 is worth 10, and in between the score rises proportionally. Meta grows 18.5, 9.3. What makes this worth anything is not the formula. It is when it is written, before looking at the result, and the same for every company in the series. If the reference moves after seeing the number, the score stops measuring the company and measures the intention of whoever is scoring. And here are the 12 scores. Valuation. It trades at 20.9 times earnings, 6.9. Risk, 3.1. Corporate governance, 1.7. Ranked 80th out of 81 in its industry, 5 years running with the same rating. Financial health, 8.8. Growth, 9.3. Sector position, 8.4. And one to explain apart, because its score is alarming. Momentum, 0.3 out of 10. It does not mean it is not evaluated. It means what it measures comes out very low, and what it measures is not the accounts. It is the share in the market. So let us look. This is Meta's share price over the last 6 months, and below it 2 indicators. 3 readings of the price, and none of the 3 is the one that sets the score. The first, the price line against its own averages. The 50-session and the 200-session averages are above the price, and that means today the share is worth less than its average of the last few months. The second, the RSI, the middle panel. It runs from 0 to 100 and says whether something has been heavily bought or heavily sold. It is at 47 with no excess on either side. And the third is the bottom panel, the MACD. It subtracts the slow average of the price from the fast one and compares that difference with its own average, which is the signal line. The difference is below the signal, so the push of the last few weeks is weaker than that of the last few months. The score, though, does not come from any of the 3. It comes from a comparison that is not on this screen. Over 1 year, Meta loses 47 points against the index, and that is the only thing that scores momentum. Hence the 0.3. And careful with what this does not say. Momentum does not say the company is bad. The scores of its accounts are high. It says the market is letting go of it. That is different information, and it is worth not confusing them. 5.9 out of 10. 12 measurements, none of them by eye. And to finish, 2 checks that are not ours, because a system that is only checked against itself has not been checked. The Altman Z-score has been around since 1968 and measures one single thing: how far a company is from bankruptcy. It combines 5 relationships between the balance sheet, the income statement, and what the market pays for the company. And careful, because it is not a score out of 10 or out of 100. It has no maximum. It is an open scale with 3 zones. Below 1.81, distress zone, up to 2.99, gray zone, and above that, safe zone. Meta scores 6.57, more than double that threshold. The Piotrowski F-score is simpler still. 9 yes or no questions on the health of the company. Does it make money? Does it generate cash from operations? Is the margin improving? And the score is how many yeses? Meta scores 5 of 9. Middle band. One says solvent, the other says merely adequate. That is exactly what our score says, worked out by 2 routes we did not write ourselves. That is analyzing a company. 7 things: the income statement, the cash flow, the depreciation, the balance sheet, the call, the competitors and the management, and a score that adds them without counting anything twice. What would knock this reading down? If Meta's free cash flow goes back above 10 billion a quarter with investment where it is, what we have told you falls apart. We will say so however it turns out. The whole methodology is in the description. The 12 axes, their weights, each formula with this quarter's numbers, and what this method cannot do. The next company, and the next quarter. Educational content, not investment advice. No price target, no recommendation. We analyze. You decide.